We had the S&P 500 fall below its 50-day moving average in this trading session, but the truth remains that the S&P 500 has been pretty range-bound, right? It's been stalling near its record high for the entire month of September. What's going to drive the equity markets in October?
Well, I think that the issue right now is that markets are starting to look at risk a little bit more, which is probably a good thing. As you pointed out, the S&P 500 hasn't done much recently. In fact, if you look over the past year, you did better in Treasury bonds than you did in the S&P 500. So I think that this risk-off story is actually a little bit more stealth than perhaps investors have been giving it credit for. So for the month of October, I think we're going to continue to see there's no shortage of headwinds for what's going on in the environment in terms of risk to economic growth and global growth, and there's going to be a lot more attention paid to that.
No wonder we are seeing these downward revisions to earnings estimates, especially in smaller caps. Take a look at this GTV chart on the Bloomberg, which is pointing to the yellow and blue line, which are the mid-cap 400 and Russell 2000. Are the big cap estimates also going to follow the smaller stocks lower as we head into the third quarter earnings season, which really isn't that far away?
Well, I think the probability, Sherry, is probably a little bit more to the downside versus the upside. And I think those earnings are at risk of coming in. The consumer in the U.S. is quite healthy, as many have pointed out, plenty of jobs. People buying houses, but corporations have been levering up in this low interest rate environment. This lower for longer environment has really turned into lower forever. And the implications are that you're seeing significant increases in corporate debt, which I think is going to start to pressure earnings as they need to pay that as well as refinance it.
You point out that the U.S. consumer is still in reasonably good shape, but are there warning signs flashing there as well? It's surely just a matter of time before these weak factory readings start to translate into weaker employment numbers. We'll have the jobs report on Friday, and then you've got a weaker consumer as well. So are there risks coming on the horizon for the consumer?
Yeah, I completely agree that there are potential risks to the consumer. And what we've really been looking at and are concerned about and have been waving the flag over is the fact that you've got the 3-month Treasury bill higher, yielding higher than the long Treasury. And that's just not normal. That's a big warning sign from the bond market that there are risks going on that the broader market isn't paying enough attention to. And so, again, I think that there's a lot more reason to be caution right now. We're not out of the market by any means, but we're certainly de-risking and recommending to our clients that they be managing that risk profile pretty closely.